Greetings from 3Edge Asset Management, and welcome to another edition of the 3Edge Weekly Update for July 6th. My name is Fritz Folts, and I'm the Chief Investment Strategist here at 3Edge, and pleased to be joined here today once again by Steve Cucchiaro, President and Chief Investment Officer at 3Edge Asset Management. Since we've now reached the midpoint of the year, today we'll be providing some insight into what we believe might lie ahead for the global capital markets in the second half of 2020. A little over a week ago marked the end of June, the end of the second quarter, and the end of the first half of 2020. And whereas the first quarter of 2020 was marked by a sudden and steep market correction brought on by the COVID-19 pandemic, the second quarter of 2020 was marked by a strong relief rally in global equities, which began in late March. However, recently, investors have become more concerned by a surge in the number of confirmed cases of coronavirus, particularly in some of the larger Sunbelt states. And investors are naturally concerned since an inability to control the virus will affect the hopes for a V-shaped economic recovery. So let me bring Steve into the conversation here. So Steve, as I said, first two quarters of 2020, we had steep market correction followed by a very strong relief rally. So the question that we are all wondering about now is, where do we go from here, and what might be in store for the second half of the year of 2020? And I guess my question would be, does everything depend on the path of the coronavirus at the end of the day? But I will leave it to you.
Well, Fritz, I agree that the path of the COVID-19 is one very important side of the equation. The other side of the equation is how the government and the Federal Reserve Board respond to all the negative developments. So what have we learned this year? And you brought this up in your comments. One thing we learned is that before the market intervention, the pandemic had such an effect on the stock market that we had the steepest drop in history. What else have we learned? We learned that once the market intervention happened, once the government and the Federal Reserve Board intervened, they did it in such a way that we had the steepest climb in stock market history. So these are two very important sides of the equation. We can't just look at one without looking at the other. Well, back to the COVID, there's a lot more data now to analyze what's driving the COVID statistics and the hospitalizations and the deaths per day and so on. And what we know now, and this is from also my involvement with the IHME, is that COVID-19 is increasingly and statistically linked with the pneumonia cycle. And what that means is we're actually on the good part of the cycle now. It's going to keep getting better, this is all else being equal, until late August. And then we could be into the true second wave, where starting in September, we could go back up and it won't peak until January. So that's bad news. What else have we learned about the COVID situation? I was able to talk at our last board meeting to three individuals who were very involved at the very highest levels with vaccine development, production, and distribution worldwide. And I asked them, what is the very best case for having a vaccine ready and distributed, timing-wise? And two of them volunteered, very best case was summer of 2021, and one of them volunteered spring of 2021. So I think it's highly unlikely, as some people would like us to think, that we're going to have a vaccine ready and going by the end of this year. Mm-hmm. So with the pneumonia cycle coming back and looking for a second wave in the fall and no vaccine, there's one other development that we know, and that is that wearing masks is even statistically more significant than we thought. And if over 95% of the country would wear masks, we know that we could delay, maybe prevent the second wave from happening. So these are the variables on the COVID side. Now, we're in an election year, and we know that there's tremendous motivation, even at the risk of long-term damage, to create and pile on as much debt is necessary to print as much money as necessary between now and the election. So we're going to continue to have a tug of war between now and the election. And what that tells us and what we're positioning for our clients is to have a diversified portfolio. There will be some days where the stock market's going to react positively to all the intervention, and we'll be glad we own stocks. There'll be other days when people will be fearful of the COVID, and we'll be glad we have some safe hedges like gold or like short-term treasuries. Now, you asked about the rest of the year. We think there could be what I would call an election hangover, where regardless of what happens in the election, there are three facts that will be inherited going forward. One is, after the election, because of what's going on, we're going to have too much debt. That's going to be a big overhang. Number two, we know no matter how strong the recovery from the lows might be, we're not going to get back to the level where we were at the beginning of this year. And number three, with the way the stock market has responded to all this artificial stimulus, valuations, assuming the stock market continues to stay high, will be too high. So those are three problems. So after the election, we have a longer term fear that we're going to be in a low growth environment, maybe with some inflation. And stagflation is a bad environment for stocks and bonds, but that's down the road.
Right. Very good. That's great. That's very, very helpful. So now I want to put up a chart, and I want to ask you to talk about it, if you would. The chart here shows how the U.S. Federal Reserve, in response to the economic slowdown brought on by COVID-19 pandemic, has dramatically expanded the money supply here in the U.S. And this is represented in the chart by the blue line at the far right, where you can see that enormous spike upwards there. In fact, when looking at the chart, it seems that describing the growth of the money supply in the U.S. as unprecedented, which is the word for 2020, that seems like a fairly dramatic understatement at this point. I mean, that's just astounding, the amount of expansion of the money supply. And so just to review, money supply is controlled by the Fed, and it's basically the total amount of money circulating in the economy. It's cash, checking accounts, deposit accounts. Now, in this chart, as we measure, we look at M2, and M2 includes that cash, deposits, and the like, but it also includes something known as near money, which simply refers to money market securities, mutual funds, and the like. So the question is, you look at this enormous spike, and the question is, what could be the consequences of this enormous increase in the money supply? And I would say both intended, right, because they've done this for a specific reason, but also unintended consequences that may lie ahead based on what the Fed has done here.
So Fritz, you presented several charts during the course of the videos that we do, and some of them have been very dramatic. This might be among the most dramatic of all. In fact, I would say that if I were a financial fiction writer and you were my editor, and I were to write a fiction story about the financial markets or the economy, and I put this chart in my book, you as the editor would say, well, Steve, this is just so unrealistic.
I don't want to believe it.
This is not going to fly even in a fiction story. So this chart, just to be clear, this goes back to 1960. So this includes all the times from 1960 to the present, all the good times, all the bad times, all the times the Fed has intervened. And what we see now so dwarfs the financial crisis of 2008, so dwarfs anything that's happened in the last few decades. And so this should help explain to people the enormous intervention that's been made and why we get this artificial boost. So what this does create is an initial artificial boost that's literally paping over all the problems that's come with the slow economy and the coronavirus. Also, it's a great way with all this money coursing through the financial system. It can't be absorbed so quickly by the economy, so it goes into asset prices, stock and bond prices, and it's helped inflate those prices. So think of it as stage one of a rocket booster, and it's taken the economy, which is in the doldrums as recently as April, and gave it a big artificial boost.
Mm-hmm.
And think of stage two as investor psychology taking over from that, and all the momentum then factors into investor psychology. They want to jump on that trend, and they want to keep the market continuing to go. So we have these very short-term temporary forces that are very powerful driving the market upward. And so I think the intended consequence was to have the market and the economy recover and have a bridge so that when the vaccine comes and when everyone gets comfortable, we're back to normal. The problem with that is it is an artificial boost, it is a bridge, and without a vaccine right away and without everything going back to normal, then we're stuck with all this money coursing through, and not money that we saved, but debt that we borrowed from the future. And as we borrow from the future and print money, you can say that the value of paper money comes into question. Right. And this could lead to longer term inflation.
Wow. And I suppose, I guess my just one quick follow-up to that is when you make the initial boost, right, and that money is circulating through the system, do you have to keep adding to it to get benefit? Do you know what I mean? Like, is that something that, so are they stuck where they're going to just have to keep doing this over and over?
That's a great question, because we've studied and we've built into our models algorithms that reflect some of the studies that the Fed has done that says that initial boost is very powerful, but then there's a decay. Mm. And a lot of the money that's been printed to buy treasury bills, those treasury bills do expire. So without continual boosting, you lose that. Yes, absolutely right. So between now and the election, the Fed and the government will have to decide, do we keep this booster going? But the more they do, the more we get into debt, and the more the problems will be long-term. So there are all these short-term reasons why the market can continue to go higher, for the next few days, weeks, or months. Hard to tell just how much, but this could all be trouble down the road, as you alluded to in your question.
All right, great. So I think that maybe one thing we can all count on is that the second half of 2020 may well prove to be just as interesting and uncertain as the first 6 months of the year. So that will do it for us. Steve and I will be back again next week with another edition of our 3 Edge Weekly Update. Remember, all of our videos are available on our YouTube channel. You can subscribe to the channel, and please feel free to share these videos with anyone who you think might be interested in listening to them. In addition, if you do have any questions or suggestions for a future topic, please feel free to send these ideas to us at our website, 3edgeam.com. On behalf of Steve and everyone at 3 Edge Asset Management, we urge everyone to remain safe, to stay strong, and to keep the faith. And Steve, thank you again for your time and your valuable insight.
And thank you, Fritz.
And thanks for listening.